Hey, welcome back, options traders. Well, will short options decay sharply over the weekend? And this is a really good question because you hear this a lot from traders, and they'll say, oh, well, I've got this trading idea. And here it is, that traders often think that it's advantageous to sell options on a Friday, particularly late Friday, possibly even going into the close. And usually with a very short-term option, maybe it's only a weekly option. And the reason is that most platforms show a large time decay between Friday and Monday. Now, a similar idea is where traders might hold short options through the weekend. So maybe they've got a covered call, they've sold this call, they're thinking about buying it back on Friday, but they're going, you know what, if I hold it just until Monday, look at all of the additional decay that it's going to experience. So let me go ahead and hold it until Monday. So again, whether it's an option that you're continuing to hold or deciding to short a brand new option, with the idea that it's going to decay sharply over the weekend. And again, the belief is that it will be highly profitable for one weekend's worth of risk. Well, like most trading ideas in the market that seem to make free money, there's always a problem. And it's one that relates in a lot of different levels to finance and financial markets, and that is that everybody else knows that information as well. This is not information that you are only in possession of. Everybody knows this. Well, guess who else knows it? Market makers. And the market makers are going to adjust for this. So market makers adjust volatility for the weekends. So they will generally lower volatility on a Friday. Maybe not in the morning, but certainly by the afternoon or late afternoon. And as most of you know, if you increase volatility in a pricing model, it raises all option prices. But if you lower volatility, it therefore reduces your option prices. So they're just going to start putting lower volatility numbers on these quotes. So the thing to understand from this video is that by close on Friday, options are usually priced for Monday morning's time decay. That's really the catch. So for instance, let's take a look at these quotes. So these were generated from a pricing model with 7 days till expiration with 30% volatility. And it says that the call option is $1.65. So we might see the bid 5 cents lower at $1.60, the asking price at $1.70. And the corresponding volatilities, again, these are the volatilities that would be necessary to put into a pricing model to generate these respective prices. So in this example, the bid is priced at 29% volatility and the asking price is priced at 31. Now, if we go into that same pricing model and we say 3 days later, or about 2.5 days later, on Monday morning, that option at 30% volatility will be $1.25. And again, this is what a lot of traders are seeing on their platforms, and they're going, you know what, that's a pretty healthy decay. Let me short it on Friday and I'll buy it back on Monday. But they also forget we have a bid-ask spread. So we're going to keep the same 5-cent spreads here for Monday. But the thing to understand is that the market makers know that these quotes right here in red are most likely what we're going to see on Monday morning, assuming that we don't have big changes in the stock's price or some big news that would radically change the volatility. And so the idea is that Friday morning, yes, you might see these quotes, but by Friday afternoon, and certainly going into the close, these quotes that you're looking at are the ones that you're expecting to see on Monday. So if you short these options on Friday, let's say that you sell them at the bid for $1.20, and on Monday morning you're expecting to see this big drop in price, you look on Monday morning and it's actually 10 cents more to close it. So there was really nothing for free. So of course, in this case, it's an at-the-money option, so remember, you've got massive gamma risk. You shorted this option, Monday morning there's really no change in its price, or in this case it's actually even more expensive, but what if that stock price moves? That gamma is either going to completely strip out that options price or it's going to pump a lot of value into it. It's going to be more like a coin flip. It's going to be a really good outcome or a really bad one. And as I always teach, you want to avoid the extreme situations. But this is exactly what you put yourself into if you're shorting options on Friday, hoping to buy them back on Monday. Or, additionally, if you've got an existing short option that you're thinking about closing on Friday, but you think, you know what, let me go ahead and squeeze out a couple of extra days, might be a good idea to close that on Friday. So some things to consider. Don't think that your short option's going to decay a lot between Friday and Monday. Don't sell an option on Friday thinking you're going to make easy money because of time decay. And the answer is very simple. Market makers understand this as well, and they are going to account for it in their prices. And it's ideas like these that you have to account for to succeed with option strategies. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.